Let's take a look at the concept of a bond swap. Now, bond swaps occur when one debt instrument is sold and the proceeds are used to purchase another debt instrument. That is, you're swapping one bond for another bond, hence the name bond swaps. And bond swaps can be used for a number of reasons. They can be used to increase current yield or yield to maturity. They can be used to take advantage of shifts in interest rates. You might also engage in a bond swap to improve the quality of the portfolio. And you might also use it for tax purposes. Now, in a yield pickup swap, an investor switches out a low coupon bond into a comparable higher coupon issue. Okay? This can increase current yield or yield to maturity. So, for example, you sell a 20-year A-rated 6.5% bond yielding 8% at the time, and replace them with an equal amount of 20-year A-rated 7% bonds priced to yield 8.5%. So we can see here that your current income increases from $65 a year to $70 a year, and your yield to maturity increases from 8% to 8.5%. So if you see an opportunity in the market to do this, this may be a good strategy to pursue. Another thing that can be done is what's known as a rate anticipation swap. Investors exchange bonds according to their duration and expected interest rate movement. So, for example, if an investor expects interest rates to fall, she's going to sell bonds with a lower duration and purchase bonds with a higher duration. Why? Because we know that when interest rates fall, bond prices go up, and they go up more for higher duration bonds. Likewise, if she expected interest rates to rise, she would swap out her higher duration bonds for lower duration bonds. So when prices fell, they wouldn't fall quite as much. You can engage in what's known as a quality swap. Investor here is looking to move from a bond with a lower quality rating to a bond with a higher quality rating, or vice versa. Now, the spread between the yields of bonds with different credit quality generally narrows when the economy is improving and widens when the economy weakens. So if you think about it, this is the case where, during times that are really good, good economic times, you might as well purchase the lower rated bonds, lower quality bonds, because the chance of the company defaulting on the bonds is much less likely to happen. So you purchase those bonds that have a little higher yield. Now, of course, if you think there's a recession coming, you'd want to get rid of those lower quality bonds and exchange them for higher rated bonds, because what's likely to happen? The price of those lower rated bonds is going to fall as people flee those risky bonds for fear that this recession may cause some of these less highly rated companies, less financially sound companies to default on their bonds. Okay, the last thing to mention is what's known as a tax swap. In this case, you sell bonds for a loss and you replace them with similar but not identical bonds. And this is the case where you may have a gain on some asset, your stock portfolio, and what you want to do is you want to sell something at a loss so that you can offset those gains with losses. Now, you have to be careful if you engage in one of these bond swaps, because the Internal Revenue Service will not recognize a tax loss generated from the sale and repurchase within 30 days before or after the trade or settlement date of the same or substantially identical security, what's known as a wash sale. That is, you can't sell your 20-year IBM bonds at a loss and then turn around and buy those back. However, you could sell those 20-year IBM bonds and purchase a bond that's similar. And generally, this term similar is hard to gauge, hard to know exactly what the IRS will determine too similar and make it a wash sale. But generally, if you purchase the bonds from another company, so if you sold IBM's bonds and you purchased, Microsoft's bonds if they had bonds, that might be close enough, to keep your portfolio similar in terms of its risk, but it might also be sufficient that the IRS does not disallow your tax loss.